Hello, coming to you today from eminitraderpro.com, where we offer personal coaching for educating day traders. If you go to the blog there at eminitraderpro.com, you'll see that I advise you right off the bat to go to our previous two blogs, as we've been expanding and evolving the material on these blogs for the past 10 years now. And at the website you can see some background and the evolution of the kind of approach to trading that you're getting from the various videos and discussions of individual trading days, and also strategies and tactics. And that's what I'm going to go into today. Be sure and look at the blog and read the prohibitions against expecting windfall profits in trading, or not knowing that you are exposed to great risk anytime you trade the futures market. So moving on from that, what I want to do is look at some of the days in the past few weeks, as the market has had a kind of a shift to greater volatility the past few days. So I'm going to start on this video with an examination of the very, very slow range-bound trade right before the past week or so, and how the market has changed drastically, and how you could have been making money in a dead market and how you might make money in a more volatile market. So what we're going to talk about is we're going to look at market structure as a sort of a foundation, a starting point for how we would evolve a trade plan and specific strategies under different market conditions. So I'd like to just start by taking a look at a chart that is what they call a naked chart with no indicators or anything other than the bars themselves, that would be traded with a price action approach, understanding certain recognizable patterns of behavior in terms of market structure, say a swing analysis, and ways of identifying a change in trend when the market structure is broken and reversed by subsequent price action. And so this is something that certain people are drawn to, want to trade based on price action alone, and I'm not recommending it, or I'm not prohibiting it or saying anything negative about it. I'm just presenting it here. And what I want to do is look at a chart on any given day and share with you my ideas on how we can gain knowledge even from a naked chart like this, or we can gain knowledge from indicators or any other number of ways, levels, resistance, support trading. And what we have to do eventually to become a successful trader is we have to decide something and make a commitment to it. So what I'm going to do is sort of start from this square one with a naked chart and just consider a few ways that we might approach it to set up something that would fit a trade plan which we develop, and then activate very specific strategies based on whatever are the repetitive behaviors that we are going to be focusing upon as a basis for our trading plan and our strategy and our way of executing trades, getting in and out of the market and making profits. So all of those things are very concrete, and all traders are faced with this process of making up their mind how they want to approach it, and the best way is to come up with something more concrete and specific that you can execute without being hesitant or afraid to pull the trigger of all the other problems traders have. So what I'm going to do is start just by looking at this naked chart and seeing, suppose we come in at 7:30, these are all Central Time. So 7:30 Central Time, I come in, maybe I like to look at the market an hour before the open, or maybe I come in after 9 o'clock Central Time because I don't care what they do for the first half hour. I want to see something that sets up on the chart after that. There are a lot of different ways to approach it. So I'm just going to start off and look at what we have coming in at the morning around 8, 9 o'clock, whatever time we want to start our structural approach. And then I start putting together the pieces to get an idea of how the direction I want to trade. The first thing is the direction, and the second thing is how can I identify targets and risks in a way that allows me to get in and out of the trade and make money, and do it consistently every day, not only ideal days, whatever people consider ideal, but regardless of the market pattern of behavior that day, slow, fast, volatile, dead, small volume, large volume, whatever. So right now, under this, let's see what we can learn about the market. One thing we can do right away is we had a high with some bars after that didn't break that high for a while. Let's just make it really simple language here. So then, one way I like to look at it is we can have a peak, and a peak is a basis for identifying a direction. Market's going up here. When it breaks that high, we look for the next one right here, and then we look for another pullback and another high here. So we have this first peak, we have a number of bars, and then it gets broken. This bar breaks but closes back under it. So it doesn't finally break out until this bar occurs right here. So now we have a second wave, you can say. People talk about waves. Let's just keep it really simple. We have a high followed by some bars that don't make new highs. That high gets broken. The market had to bring in more energy, more money, more participation from traders. And eventually they peaked out here, had a little bigger pullback this time, made a new high, but then we had, if we were looking at this in real time and we only saw this, we say we don't know if that's a low or it's still going to go lower or whatever. And then right around here, we can see now it's made a high, a low, a lower high, a lower low. So that is something that is all based on what we see over and over and over. A lot of times the market has a straight up rally in the morning. We're looking at the NASDAQ here. It's very, very common in the NASDAQ. You have a very strong direction till 9 o'clock or 9:30, and that can be the high for the day. And the same thing when it has a big sell-off where you get a low that lasts for the low of the day. But we don't know any of that. We just want to figure out how to make money. So we have to have something we can identify. Well, after this high's been put in and we're starting to wonder, should I be buying pullbacks? A lot of people say, okay, this is a trend. So I want to trade with the trend. So I want to buy. Well, after a while it gets a little bit confusing. What is this now? It looked like it was a straight up market, but after 9 o'clock, 9:05, it's just it's going straight down like it's a downtrend. And this is the problem with simplistic ways that people trade. They say, well, if I'm above the 21 moving average, or if I'm above the 50, I buy all the pullbacks if it's going up, or I sell all the rallies if it's going down. The problem is, a lot of times the market, the indexes, especially the S&P, the ES, and the NASDAQ, the NQ, they just make straight moves and then they turn around and go the other way. So one thing you can do, though, is you can look all the things people look at. You could say, okay, I want to look at Fibonacci, for example. So I'll go to my drawing tools and I'll put up a Fibonacci retracement indicator. Messed up the first one there. Let's pull that down a little. Okay, so the market went down. It went to what we can identify as the low here. Went up to 60. The high tick was 62%. Almost got there here. Almost got there. But now we're having a basis to say, well, I didn't get any obvious bull rally after this high. If I got in on the pullback down here somewhere, I might have made 2-3 points, but what's your trade plan? You got to figure out ways to do that in a way that you can consistently make money. So another way is just wait till that first half hour is over, or the first hour of trading, and then watch the structure develop and make decisions based on that. So having seen that high there, and then this low here followed by this rally, this was a 62%. One thing we might want to do is just sell any one of these highs with a tight stop. And then you're going to be, apparently, this is a market that's getting weak, because what's happening here is you have a lower high and a lower high and a lower high. So this is a structure technique that I use that comes up many, many times, sometimes 4 days a week, 5 days a week even, quite regularly, where when you get something that in retrospect becomes a high, you don't know in real time if that's a high or if it's going to rally again and go higher in a few bars at this point. But after these lower highs, then you have a significant high that's been put in with lower highs and lower lows. And what happened was, when they rallied, there were more sellers each time at a lower price. So you had a high here. This time they started selling it lower. A few ticks lower, they sold it, and then another tick or two lower, they sold it. So you had 3 lower highs after a significant high. That's a really great place to get into a trade. Now, you can get in a number of different ways. People sometimes just like to draw a trend line, and you can get in on this bar here and put your stop up here so you didn't get hit with this one. Or another way is you could wait till the support broken becomes resistance, and you could sell that one at the trend line. These are all different tactics that can be part of a strategy. I'm just throwing all kinds of things at you for the purpose of understanding how we look at market structure and then how we decide to structure our trade plan. Now, seeing this sell off here, if you're in this trade, this would be a trade where you would like to take at least, let it give you a profit somewhere approaching the next quite significant support point, which is this pivot low here. So now we're starting to see structure develop as we mark up our charts, and it starts to make a little more sense what's going on. Maybe you thought, okay, I'm a counter trend buyer in a sell-off, therefore I'm going to be buying it somewhere around this low. Well, if you do that, I do that kind of trading. I trade support and resistance and levels, market structure points of support and resistance. And then I scalp, basically. I look for something in the NASDAQ 6 to 12 points, commonly sometimes 6 to 12 ticks. And sometimes up to 16 ticks. Taking 4 points would be a pretty good trade for a scalper. And then the idea is you trade with more contracts. If you're going to scalp, the advantage of that is it's a lot easier to get a few ticks than it is to get a few points. It's a lot harder. The probabilities drop significantly if you're holding longer and longer time range. So I like in the NASDAQ to get a few points, maybe 2-3 points, maybe 4 points, but that allows you, even when this is nothing significant at all, if you make your entries at an optimal point where you're not risking very much, it's a lot easier to get 3 points. So the low here was 97.50, and this was, almost 6 points higher. But basically, I'm seeing these stems here at this support point, and I'm primed to get an order in somewhere around the price of that level. So let's say 99, and then exit somewhere underneath these highs here at 02. So maybe 2-3 points on a scalp. But otherwise, if I were going to be holding for a longer term, then I would be looking for something more significant to develop, because basically this just failed. as you never could get above this pivot here. And then that's another point where you got 3 highs. So these are what I call retest failures. A lot of people call them retest failures, where you have a point of resistance and the market tests it and fails. Test and fail, test and fail, test and fail. So then this becomes a good point to sell. You finally get a close underneath the key support. You get a green bar that reverses right away. This is all indicating solid reversal to the downside after this structural, say, bull phase of the market. Once it broke these lows, the momentum was indicating it would probably break the support point, and we'd have a selling pressure for a while. Okay, now at some point the market generally finds some support. It had a big rally here, so later in the day you're just looking for key support levels if you're trading this kind of structural approach. And then you're looking for some parameters on how to trade in a different direction. And what we see is this is our pivot before the final sell-off, and so the market wouldn't be really solid buying opportunity until it breaks that level. But another way to look at this is if a level is regained, that's also a pretty good indication the market is lost the advantage to the sellers. The seller's advantage is not holding the market down anymore if the market price action is able to regain previous range of trading, previous levels. So once this pivot is broken to the upside and this level of pivot is regained in this action here, the market is looking much more bullish. And then your opportunities would be to buy these small dips. Now, all of that can be seen just on the basis of this price action, but I think for most people this would be pretty hard to really execute. It's easy in hindsight, but what's our plan? When do we pull the trigger? When do we have tactics for getting in? So what I'm going to do is stop the video here and go on to part 2, so please be sure and watch part 2 of this video. And what we're going to look at is the approaches a lot of traders use with various adding on to the naked price bars with more information by applying some different tools or even some indicators. So that's what we'll do on part 2. So look forward to finishing the topic in part 2. Unless we get a part 3, then we'll finish it there. Okay.